Thank you for listening in. My name is Steve Blumenthal. In today's podcast, we're going to look at the state of the energy space. I had the absolute pleasure of interviewing Adam Rozencwajg and look forward to sharing that discussion with you. Adam and his partner, Lee Goehring, founded Goehring and Rozencwajg. Their background is impressive. Lee was a manager of the Prudential Jennison family of natural resource funds between 1991 and 2005. Those funds reached over $3 billion in assets at its peak. He was a portfolio manager of the Chilton Global Natural Resources Fund from 2005 to 2015, managing $5 billion at its peak. Adam joined Lee at Chilton in 2007. Prior to that, Adam worked in the investment banking department of Lehman Brothers. They left Chilton in 2015. They formed their own firm. It's a fundamental research-based firm focused exclusively on contrarian plays in the natural resource investment space. They focus on the global commodity and natural resources markets, looking to invest when prices are depressed, investors are discouraged, and valuations are cheap. We talked about the state of the oil and natural gas markets, small modular nuclear reactors, uranium, and more. The podcast was recorded in July 2024. You can learn more about Adam by going to their website, www.gorozen.com, GOROZEN.com. Before we get started, investment involves risk. Past performance is no guarantee of future results. Different types of investments involve varying degrees of risk, and there can be no assurance that the future performance of any specific investment strategy, or product made reference to in this podcast, directly or indirectly, will be profitable or suitable for your portfolio. Diversification and asset allocation do not ensure a profit or a guarantee against loss due to various factors, including changing market conditions. The content of today's discussion may no longer be relevant, and current opinions and positions may change. Moreover, you should not assume that any discussion or information contained herein serves as a receipt of or substitute for personalized investment advice from CMG or any of its related entities, or from any other investment professional. To the extent that you have any questions regarding today's podcast, I encourage you to consult with your professional advisor. You can find additional disclosures in the show notes. Please know that CMG may have investments in the Goehring and Rozencwajg Investment Fund. Thanks for listening. Bullish on energy. Let's go. Adam, good afternoon. And thanks so much for taking your time to be with me today. I'm really looking forward to getting to know you and our discussion around the energy space.
Well, thank you for having me. Glad to be here, and thanks for your interest. And yeah, looking forward as well.
Well, give us a sense of your background. You know, where'd you come from? What do you guys do? And start there.
Sure. So here at Goehring and Rozencwajg, we are dedicated natural resource equity investors. So we buy listed companies, listed shares in companies that explore, produce, develop oil and gas fields, mining projects, both base metals, precious metals, uranium. We were very early to the uranium story. Everyone these days is a uranium expert. And a little bit, unfortunately, a lot of people are uranium bulls, but we became bullish at the absolute bottom back in 2018 and 2019 when, these stocks were being given away for less than book value. And we start everything from our investment approach. Everything is research driven. And so our research is really, I don't think I'm boastful here when I say it's really the best in the industry. We spend a huge amount of time coming away with very contrarian, very differentiated opinions and views. And we then build a stock portfolio around that to be able to take advantage of the research, take advantage of the big cycles that the research tells us are at an inflection point. We like to buy things at the bottom. Not many people do that. Lots of people say they like to do that, but they much prefer to buy things after they've gone up already, and you get that comfort. We like to focus on these areas of the market that are just left for dead.
So
Where
give us an example. You mentioned uranium right out of the gate. What were you seeing in uranium that turned your view bullish?
Sure. So the uranium market's a really interesting one. And this actually ties in a little bit with our background because we've been doing this a long time. My partner Lee started managing natural resource equity portfolios in 1991, and I've been doing it for 17 years. I joined him at Chilton in 2007, and we've been working together ever since. So it's been, can't believe it, but it'll be 20 years in a couple of years here coming up. And the process has always been the same. We try to find these areas of the market that are totally out of favor. And so what was it about the uranium market that really captivated our interest? Well, you have to go all the way back in some ways to 1980, if you will. And just bear with me for a sec, because I'll get us through this pretty quick. So from the day that we first split the atom through the Manhattan Project and then through the advent of nuclear power in terms of electricity generating stations, we basically always had a market that was in surplus. So there was these huge uranium booms in the 60s, and they were all based on the idea that we were going to have this new source of power and it was just going to displace everything. But we always found more uranium deposits than we could actually spin up new reactors. So you constantly had this surplus, and governments around the world bought up the excess material. They bought it up for their weapons programs, and they bought it up to make sure that their enemies couldn't buy it up for their weapons programs. So by 1980, you had the situation where the Soviets and the Americans both had these massive stockpiles, both of nuclear weapons and then of just unused uranium that could be enriched to weapons grade and made into other weapons. And the Soviets in particular obviously had a financial issue. And so they approached the Americans and they said, I think it would be really good for both our finances, our coffers, as well as just the world, if we did entered into what was then known as the megatons for megawatts project. So they decommissioned a lot of their warheads, and they also took all of those stockpiles, those government stockpiles, and put them in the commercial hands and made them available effectively to utilities. And that had a major depressing impact on uranium prices. They fell by half. The US went from being the world's largest uranium producer to producing no material at all. And for the next 20 years, those stockpiles bled and bled and bled. And so in the early 2000s, Lee and others did a bit of back of the napkin math, and they said, look, I think by 2003, 2004, we're going to have run out of these stockpiles entirely. And then you'll be kind of heads up again. And we're not producing enough from the mines to meet the reactor demands. It's all being met by the secondary supply. And sure enough, that happened. And uranium went from 8 to 150 in about, a couple years. And it's a really strong bull market. We were involved then. We owned uranium stocks then. They were very strong performers. And then, of course, the GFC happened, everything pulled back, rallied back, and then Fukushima happened in 2011. So we were actually out of the uranium market. We actually sold it well. Not only did we buy it well in the early 2000s, but we sold it well right at the top in 2007. And then after Fukushima happened, we actually bought a little bit again. We said all these stocks are down 50, 60%. That was exactly the wrong thing to do, and we exited it quite quickly. And the reason it was the wrong thing to do is that, of course, we were on the path to decommissioning nearly 30% of the world's reactors. And as luck would have it, the boom in the early 2000s brought on new mine supply in the mid 2010s, just at the time that all these reactors shut down. So now we started building up stockpiles again. The market was in definite surplus. We stayed out of the market entirely. Prices fell by 90% over a decade. All the new projects that were expected to come online never did, but the Kazakhs did boost production and the Canadians held in. And by 2018, the market had slipped once again back into deficit, but you had this huge cushion of commercial inventory. So mine supply was no longer enough to meet the utilities demand, but you had this huge commercial inventory. So what had been a government inventory was now a commercial inventory sitting mostly in Japan. And so we said, okay, look, we're starting to get interesting here. Uranium prices are $18. There's two companies in the world that produce uranium primarily on a primary basis. One is Cameco in Canada. The other is Kazatomprom in Kazakhstan. Their cash costs to produce were 25, and here the price is at 18. Okay, the stocks were trading at 70 cents on the dollar book value. And
Wow.
at the time, there's only Cameco that you could buy because Kazatomprom hadn't even listed yet. So there's one company. It was a single digit stock. It was, 75 cents on the dollar book value. And they had long-term contracts at $50. The cash cost to operate their mine was 25. The spot price was 18. What did they do? Something I've never seen in the history of the mining industry. They showed restraint and they showed sensibility and they closed their mines and they ended up buying the spot material to deliver into their contract book. So you
Hmm.
had this situation where like it's a clearly an unsustainably low price. The industry cannot survive at this price. You won't have a uranium industry if uranium stays at $18. You don't have valuation risk because could it go from 75 cents to 50 cents on the dollar book value? It's possible, but I mean, you have real true asset value there, irreplaceable asset, no debt on the balance sheet, or they had debt, but they had net cash, so more cash than debt. And we thought the prices would have to re-rate higher. And oh, and by the way, once they shut the mine down, if uranium prices fell lower, they would actually make more money on the spread between the spot price and the term
Mhm.
contract. If uranium prices went up, then the asset value of the mine would kick back in, right? So it was unusual that we got such a nice, neat, tidy little package, but we became really bullish back then. And sure enough, the market slipped into primary deficit. You had this big cushion of inventory stockpiles. We again tried to map out when we expected those inventories to deplete. We thought it would be 2020, 2021. It's basically right. It ended up being 22. And prices went off to the races. And so in 2022, prices had crept up from 18, maybe they were 30, and then boom, they just popped up to 85 where they are today. And they
Was
crossed
there an
100.
event that triggered this? Was it a realization of moving away from the potential green energy boom and what that might, what was a trigger for that?
Really, the trigger on the uranium price itself was simply the idea that the market had been in deficit for 3 years, and that deficit was being completely obscured by inventories, which were one time in nature. And so
Hmm.
the fuel buyers, when they entertained offers, they were always like, okay, Cameco's coming to them with a price that's here. Nah, let's just go into the secondary spot market and find some excess material sloshing around. And they basically always could. And so no one was incentivized to lift their bids on any of the, requests for proposals and things like that. And then from one day to the next, it became really, really hard to find that material. And so then they began to panic and prices lifted. If there was a single catalyst that I think really ushered in that shift, it was probably the introduction of the Sprott Physical Uranium Trust. I'm not sure if you're
Right.
familiar
Yes.
with that.
Follow that. Yes.
So that's the name, we owned the predecessor company, which was known as the Uranium Participation Unit up in Canada. And that was a sleepy closed-end fund. And they basically bought and held U3O8, pounds of yellow cake. And they would keep it, in an authorized warehouse, and it would just sit there. And that's basically what they still do. But back when it was the Uranium Participation Note, they were really, really conservative. They had no interest in going and bulling up the story, telling people about the benefits of uranium. And in fact, there was a rumor that every time their NAV traded at a premium, they got really annoyed because they would have to go and file a document and issue new shares and place the shares, even though it meant more fees for them. Like, they weren't interested in any of that. They just wanted to keep it steady Eddie, and off they go. Sprott took a totally different approach. They put an at-the-money facility in so they could go at any time where the stock price is trading, or the unit price is trading above the net asset value. They could issue shares into the market and use that money to buy new pounds of uranium. And they got out into the market and they started to really talk about why they felt this market was tightening. At the beginning, there was a little pushback where people said, well, is this rally sustainable, or is it sort of market manipulation almost, right, on the part of Sprott? Not really manipulation, but is it
Yeah.
just kind of fake? Our view was always very different. Our view is, no, the supply demand fundamentals are really positive, and Sprott's taking advantage of this opportunity. There's a reason they didn't launch the product 5 years ago or 6 years ago or 2 or 3 years from now. They see the inflection point. And I think in retrospect, that view was vindicated. And that was all based on our modeling of supply and demand, which painted a very, very tight picture.
Okay. So how does that picture look today?
So the picture looks today to be incredibly bullish for the next 5 or 6 years. The stocks are not as cheap as they were in the past. And in fact, some of our uranium names are approaching our long-term price targets. And so we've been trimming them just a little bit, trimming the hedges, I guess, as we would call it. We're still really bullish. We want to continue to have exposure to the space, but I think it's prudent that if a name pops up against our long-term equilibrium price, we should probably use it as an opportunity to pair off a little bit.
So you're primarily playing in underlying equity positions. Do you trade the spot price too?
No, we don't.
Okay.
Now, we do own a little bit of the Sprott, right? So that's a bit unusual for us. Typically, like in the gold sector, for instance, we own gold miners. We don't own the GLD. In oil, we own oil companies, producers.
But it gives you easy access to the spot price.
Yeah, it does. And in the case of uranium, there's just not a big universe. We want to have 20% of the portfolio invested in uranium right now. And there's not a really good basket of high quality projects to get you there. You would have to have some really concentrated positions. We don't like our individual names to get much above 5 or 6%. And so, the Sprott sits there to kind of keep that exposure up. Now,
So
what's interesting, I'm sorry.
Has the mining picked up? Other miners gotten back into the space? And then how does that square to the expansion back into nuclear facilities?
Yeah.
How many of those are happening? What's the timeline for that demand to pull from?
All great questions. And the uranium market's a little bit different than any of the other markets that we follow. So for number one, there's no such thing, it's not really true, but there's very little in the way of demand destruction when it comes to uranium. So whenever we get excited about an area, we stop and think, okay, what's the roadmap of things we should see as time goes on? And how are we going to know that this theme is played out and it's time to exit?
Right.
And it can either be because price rises too high and demand gets squashed out. I think that's how the oil bull market ends, by the way. Or it can be new mine supply comes online and that overwhelms demand. In the case of uranium, it's not going to be demand destruction because once you've built a nuclear reactor, it's quite expensive relative to the fuel costs. So you could easily run $200 or $300 uranium. Remember, the price was $9. Today it's $80. I'm sorry, it was $19. Today it's $80. And we think it could run to $200 or $300 before the utilities really start to have an issue with buying uranium. So it's not going to be demand destruction, but it will be supply. Uranium is not the most rare material in the world. It does take time to bring on new deposits. There hasn't been much in the way of exploration, and there hasn't been anything in the way of mine development. But eventually, with the right price signals and the right incentive pricing on uranium in particular, you'll bring on enough supply to meet demand. And so that's what we pay very close attention to say, when is this bull market going to be over? So what price gets it done? Probably 125 on an ongoing basis with the right availability of capital markets. You could bring on enough in the next 7-8 years, let's say. So that's what we run through our long-term price target with the understanding. So that's what we use when we calculate our DCFs and our price targets on the stocks. But with the understanding that I think you're going to get a price spike well above that. So this is one of those markets where I do think that you can hold it a little bit above that equilibrium price, but you have to start to get cautious.
Are there other parts of the world where they're opening mines?
So nothing in the near term. There's parts in Africa that host uranium deposits. There's certainly Kazakhstan, which we could talk about the supply picture there because it's becoming really challenged in a hurry. And then there's Canada. Those are the big producers. And we're starting to rehabilitate some mines here in the US. But nothing's coming online in volume until the end of this decade. So we try to be long-term investors. I would call 2030, fairly long-term. And in that time horizon, this will be a completely supply-led story, right? New nuclear reactors, we know what's being planned, proposed, and under construction. So that's obviously in the model in terms of demand. But all this, new nuclear revolution, the small modular reactors, that's a 2030 story. Nothing in that will happen in the next 6
general,
years.
are you positive on that technology?
Yes, absolutely. And I'm happy to talk about that in a second because I think that there's very few people who have done as much work on the SMRs as we have, and it's a wonderful story. So I'll talk about that here in one quick second.
Okay.
So in the short term, it'll be supply led. There is there are two new sources of supply between now and 2030, and both seem quite challenged. One is Kazakhstan, and they announced that they would increase production this year and next year. This year has already proved to be a failure, and in August, they'll be announcing their projections for next year. That material has all been spoken for. The Chinese basically signed long-term contracts against it. And I think there's a very good reason to think that they're not going to be able to hit their goals for next year. One of the reasons is it's mostly geological. My partner, Lee, was actually in Kazakhstan about 6 weeks ago, trying to talk with the company and understand what was going on. And they have broadcasted to the world as sort of a sulfuric acid shortage, which is a key component for how they produce the uranium in that country. And so that kind of makes it sound like it's the supply chain bottleneck, and we'll just kind of work that out, and then we can bring production back up line. And they're not wrong. It is a sulfuric acid shortage, but it's a little disingenuous because the reason they have a shortage is that the rock is consuming way more sulfuric acid than they had expected. That's a problem. There's more carbonate basically in the rock than they had expected. And that means that the productivity of this new field that they're bringing online is not as high quality as what they had before. So yes, it is sulfuric acid, strictly speaking, but it's also an issue of resource depletion, which is something we spend a lot of time on. So that's number one. I think that's going to be a big disappointment. The second is a company called NextGen. We own NextGen. They have the best undeveloped uranium mine in the world, I think. It's in Saskatchewan, near Cameco and their productive assets. Super high grade, really, really, really good economics, good rates of return. We like to look at the NPV of the project relative to the initial capital that goes into it. That kind of blows the lights out. So everything looks really good there.
NPV being
the net present value. So basically just the DCF. We do a DCF, a discounted cash flow model, using our, $125 uranium long-term equilibrium where the market can settle in the long term. I don't care that it's well above the spot price. I'm willing to use that and underwrite that. And we say, what's the project worth relative to the initial capital that is needed? And we like to look for multiples of that initial capital that's needed. And in the case of NextGen, you get that. They say that they're going to bring that on in 2027. I have no problem with the asset. In fact, I love the asset. The timeline is really aggressive. I don't think it's going to happen. It's in everyone's models, though, is happening, and it's 20 million pounds. It's really big. It's just not going to happen. It's just not going to be there. And so you blow this massive hole in the supply-demand balances in the back half of this decade, and that's what's going to cause prices.
That's what's getting you to 180.
Yeah. The other thing that I would point out that's a little bit different, most of the markets that we like to look at, if you want to buy things at the bottom, the fundamentals usually aren't great at the bottom. The market's probably in surplus, but our trends are showing that surplus is about to give way to a deficit. That's where you really want to focus. What's so unique about the uranium markets, you're in deficit today. You've been in deficit for 2 years. It's been obscured by this big inventory overhang. And so people say, well, how many new reactors have to come online? How much does China need to accelerate before this market gets tight? So guys, it's been tight. It was tight yesterday, last month, last year, but people didn't appreciate it because of the inventories. And so that's what's really different. Not much has to happen for this to really get out of control. The damage has been done. We've starved it for capital already. And so, I think that the kind of writing has been set now for the next couple of years.
So how does this? Well, I want to get to the small nuclear. How I'm really curious as to your overall thoughts on oil and nat gas, and how small modular reactors impact your view.
Sure.
So let's go there.
Sure. So I think that small modular reactors are going to make a massive, massive impact. It's all going to be in the 2030 to 2040 and 2050 timeframe.
Okay.
So in the near term, gas is critically important for a variety of reasons. Every fuel, every energy source can be graded on many different metrics. But two that we like to focus on, we do like to focus on energy efficiency. So if you put 1 unit of energy into a natural gas ecosystem, how much can you pull out of the ground, convert into electricity, and get into people's homes. And then, of course, carbon is an important consideration as well. Nuclear is off the charts efficient and no CO2. Gas is off the charts efficient, not as good as nuclear, about half, but still better than coal and certainly better than renewables, which are very poor on that metric. We could talk all about that because we've done probably more work than anybody on what the drivers of efficiency in wind and solar are.
That will counter the belief of a lot of people. So interested there. Yes,
absolutely. And compared to coal, gas has half the CO2. So I think gas is a really important fuel. Looking to the 2030s and 2040s, I think it could come under competition from uranium, which is objectively a better source of energy on every metric you look at. So what is it about the SMRs that makes us so excited? Well, we first started to research the small modular reactors a couple years ago because I was reading all these reports in the Wall Street Journal and whatever, and everyone was talking about how the SMRs were coming in to change the world. And it kind of piqued our curiosity because in the energy industry, it's very unusual that small is cheaper than big. Oil refineries, you don't have the neighborhood small little, artisanal oil refinery. You have these massive projects because there's huge economies of scale to it all. And so the idea that a small nuclear reactor would be better than a big nuclear reactor really struck me as odd. And I realized that nobody knew what they were talking about. Like I said, somebody has to explain why these things are better because otherwise I won't believe it. And so we went out and we started looking at them. And I've actually gone to visit several. I've been to Bill Gates's company out in Washington.
Well, there really aren't many ways to play this at this point for an investor.
There's not many ways in the public market to play small modular reactors. There's two now. One is a company called NuScale, SMR is the ticker, and the other is Oklo, which is just listed via SPAC demerger. And we can talk about them because their technologies are fundamentally different. So there's about as many flavors of small modular reactors as there are, whatever, pick your analogy. But there's two that are being advanced more than the others, and I think have the highest likelihood of success. And one is the clear winner over the other. So the first is what NuScale is doing. NuScale has taken a large reactor, what they call a pressurized water reactor, and I'll explain what that is in a second, and they made it smaller. They made it about a quarter of the size. So it's less output, less footprint. The whole thing is just shrunk down. And their view is that by doing that, they can actually build them in a fabrication facility, basically an assembly line, and get costs down. And I suspect that's true. I mean, I think if I had Ford come and build me my car on my driveway, it probably would be more costly than having them do it in their factory and ship it to me. So I suspect they would be able to lower their costs compared to a conventional reactor. But, you lose some economies of scale. It's smaller. And what could that be? I don't know, 10, 20, maybe 30% cheaper, but there's nothing fundamentally that's different, right, about these technologies. And the way the technology works, and this is basically the same reactor design they would take issue with that. They've made some tweaks and bells and whistles, but the underlying principle hasn't changed. And that is you take a bundle of low enriched uranium, you put it into fuel rods that are configured just so. They'll create a chain reaction where uranium isotopes split apart, release energy. That energy elicits another one to split apart, on and on and on in a very controlled manner. And that is radiated in the form of heat. That entire fuel bundle sits in a pool of water, and the water absorbs the heat, which is then pumped into a heat exchanger and ultimately into a steam turbine to make electricity. Now, the fuel core will give off heat at about 500 degrees C. Water, of course, boils at 100 degrees C. So what you have to do, just like your car's radiator, is you have to keep the water under pressure to keep it from boiling, and you need to constantly pump it. So now what you're talking about, and mind you, that's a great technology, right? That has provided some of the world's most efficient, reliable electricity with no carbon for years, for decades, in fact, right? You're extending the life on some of these facilities now into their fifth, sixth decade because they're so reliable and they work so well. So nothing to sneeze at, but there's some challenges. Because you have very high pressure steam that's been irradiated, you need to have incredibly thick pipes. They need to be really fault tolerant, because the last thing you want is a steam explosion with radioactive steam. You have to have incredibly thick weld joints. And if you look at all the reports of these cost blowouts, it's always the welders. They can't find enough high spec welders to do these jobs.
Interesting.
You need some of the world's most sophisticated valves, both in terms of just their ability to handle pressure and their fault tolerances. And with all of that, oh, and then you need to put a big containment vessel over the whole thing of really thick steel, so that if something blows on the inside, you're able to contain it in the containment vessel. Then, it's really, really high pressure and very high specification. Because of all that, you then have this massive, massive steel structure that needs to sit on this huge cement foundation, much larger than you would think, to be able to support all that weight. And again, with Vogel in South Carolina, where that big cost overruns, there was the weld joints, and it was laying of that concrete properly to within the right specifications. NuScale is going to suffer all those same issues, but smaller. TerraPower and Oklo have taken a fundamentally different approach. They got rid of the water and they replaced it with salt. And salt, it turns out, at about, don't quote me on this, but about 300 degrees, actually melts from a solid into a liquid. And if you're looking at it, it looks just like water. It has this very similar viscosity, at least to the naked eye. It has a lot of the same properties, but its boiling point, instead of being 100, is 900. So it's like extremely hot water. If you dipped your finger in it, you'd get burned quite badly. Melts at 3, boils at 9. The core is right in the sweet spot at 500 degrees. And so it emanates all this heat, and the heat gets absorbed by the liquid salt and still gets sent to a heat exchanger, and that boils water and spins the turbine. That's all the same. But now you have no pressure in the system, because you don't have to worry about boiling off the salt. It'll never boil off. If you walked away from the entire thing and stopped it circulating, the salt pool could absorb all of the heat in the entire life of that nuclear core. Eventually, the whole thing would freeze back to a giant block of salt. So now you're like, 4-inch steel is down to, off the shelf 1/8-inch steel. Your valves, you still want them to be, fault tolerant, obviously, but you don't have to handle any pressure. So you're not talking about sophisticated. And the entire bill of materials, believe it or not, per unit of electricity dispatched in a fourth, what they call a Gen 4 reactor or TerraPower reactor, is about 90% less material. And that means that your cost savings are through the roof. They're safer, and it's a fundamentally different approach. Oklo is taking a very similar approach to TerraPower. They have longer to go, though, to get approved by the regulators, because it is a new design. Now, new design is not really the right word, because the Navy and various research laboratories in the United States have actually been running a molten salt reactor for 60 years. And so we have, millions of hours of data on them. It's not a new technology. The reason that we went the direction we did was that the civilian nuclear agencies and utilities took their cue from the Navy nuclear power program, which of course was used to power vessels and submarines. And there's some reasons why, really hot salt and water can create, fires. And so there's some very real considerations why the Navy might prefer to use pressurized water and not molten salt on vessels. And then thus far, the civilian energy industry has just taken their cues from the Navy. But this is not a new revolutionary design. It's been around for a very long time.
Ultimately, the customers and the buyers of the utility companies?
In terms of who's gonna ultimately buy the small modular reactor, there's some debate about that. So the Oklo is looking to provide energy as a service. So their idea is they're going to own the asset.
They'll be it. Yeah.
Yeah. In TerraPower, they're taking a more traditional approach. So their first pilot project that they're doing is actually a joint venture between them and Bill Gates's utility. I'm blanking, Pacific Corp, I believe.
So so Gates is behind the TerraPower.
Bill Gates is behind TerraPower, Berkshire's behind Pacific Corp, and then the U.S. government's kicking in $2 billion for the first pilot project. And what's super, super interesting, right, is that there's been so much talk about AI and data centers and electricity demand and stuff like that. And the truth of the matter is, we know quite a bit about AI. We've actually built our own artificial neural networks and AI engines 5, 6, 7 years ago to help us analyze oil and gas wells. So believe it or not, even though we're not technology investors, we actually understand the mathematics and the technology of this better than most. I think there's lots of good uses. I don't think anyone has any idea in terms of their projections on AI. So you take that with a little bit of a grain of salt. But the two major backers of the most advanced new small modular reactor companies, you have Bill Gates behind TerraPower, and you have Sam Altman behind Oklo. And Bill Gates, when he talks about TerraPower, that's his biggest passion project. He's involved in lots of tech startups that are looking to solve climate change. But if you look at how much time he dedicates and how much money he's dedicated, TerraPower is definitely a darling of his. He comes at it more from the approach of trying to reduce carbon emissions and climate change. Sam Altman comes at it very, very straightforward. He says, when I put out Chat GPT and OpenAI, we're not going to be able to power it. That's going to be the bottleneck. And so I want to own that power as a service as well to be able to plug in.
I think it's really smart. We have a client who owns a bunch of data centers, and what's coming down the road seems to be the need is gigantic, and the ability to power them is necessary.
It is.
One of the companies we're looking at, I won't mention names, that we've approved on our platform, essentially builds and operates small utility facilities next to data centers or large manufacturing centers or what have you, that are essentially off the grid, self-powered, which is where my interest in this small nuclear is tied to what the threats are to their business model and oil and those sorts of things.
Yeah, no, absolutely. And I think you're seeing more and more of that. And there's a whole variety of reasons. I think that wind and solar are very destabilizing to grids. And I think for people that need really high reliable power without the volatility, being able to kind of have your own cogen, which, of course, there's been industries where that's happened often throughout history. And I think we're moving back to it. So I think the SMRs are definitely incredibly promising.
But
but it's 2030 to 2040.
Yeah, 2030 to 2040. All right. Let's dive into oil and nat gas. Your supply demand view, your overall view, and any thoughts that you have.
Absolutely. So I'll start with oil, and I'll be pretty brief. We spent lots of time talking about nuclear, but I'll try to distill this one down to be a little bit more succinct.
You're doing great. You're doing great. Keep it going.
What's taking place in the oil markets today has only happened twice before since the age of oil. And that is the key growth driver in non-OPEC supply growth is now beginning to moderate and eventually roll over. And this has been incredibly disruptive every time it's happened before. The first time was back in 1970 when the US, their conventional oil production, at that time total oil production, rolled over. The US had been the huge growth driver of non-OPEC oil supply in the decades prior. Obviously, oil was discovered kind of simultaneously in the US and in Azerbaijan. The US was obviously a major growth driver in the early part of the 20th century. And in 1950 something, King Hubbert, who was a shell geologist, came forward and put out his view as when he thought U.S. production would peak and roll over. And that was a hugely controversial claim, right? Because the U.S. was just in its ascendancy. It wasn't clear that you were ever going to roll over any of these fields because you never really had, other than really small localized fields. But what he used a whole bunch of fairly rudimentary mathematical techniques to say that an unencumbered oil or gas field will ramp up, accelerate to the upside, peak, plateau, and roll over. And when it's all said and done, it'll look like a bell-shaped curve. And it'll peak once half the reserves have been produced. So if you can make an estimate as to what the reserves are, you can try to take a stab at when it's going to peak and at how much. And he did that in 1950 something and concluded that 20 years on, the US would peak at whatever it was, 11 million barrels. And that's exactly what happened. And so it caught the whole world by surprise. And, there became a little bit of a cult of King Hubbert that to some extent persists to this day. And it was major, it had major destabilizing impact on the global energy markets. It effectively allowed OPEC to gain market share, pricing power, and engage in 2 oil embargoes throughout the 1970s, right? If the US was growing and accelerating its growth, OPEC wouldn't have been able to do that effectively. They would have looked to cut production, and the US would have just grown to meet it, and you wouldn't have had the same impacts that you had. So massive. Oil prices went up, 10, 15 fold. It's all anyone remembers about the 1970s was the energy crisis. The same thing happened, interestingly, in 2003 and 4. So everyone kind of thinks about the last oil bull market as being China. And certainly demand from the emerging markets was an important part of the story, which, by the way, is still an important part of the story and is not slowing down at all. Everyone talks about it, and it's just they're using the wrong models. Energy demand in the emerging markets is really robust. But another thing happened back then, and that was that after the 1970s, when oil prices boomed, eventually got up to $45 in 1980, we had a major exploration boom. The energy stocks did extremely well through the 70s. It attracted a lot of capital. That capital got put to work in exploration, and we found a lot of oil. We found the North Sea, we found the Gulf of Mexico, and we found Alaska developed. And so through the 80s and 90s, you had a lot of oil in the markets, right? And again, non-OPEC oil supply showed very strong periods of robust growth. That all gave way in the early 2000s, and that was exactly when, again, OPEC gained pricing power, market share. They cut into a tight market, and prices went eventually from 19 up to 150, right? Big rally. And today, we are seeing the major source of growth in the non-OPEC world, aka the US shales, are now in the process of rolling over. And in fact, people don't really talk about it, but last year, you started the year growing like 1.1 million year on year, January 23 to January 22. By the end of the year, you were down to like 200,000 barrels a day of year on year growth. And everyone kept writing these headlines like US makes another all-time high, breaks its old high and makes another time. Yeah, that's true. But guys, you're kind of missing the point. You're doing this peak and you're doing this plateau. And the question is, are you going to do the rollover? And we think the answer is unequivocally yes. So what we did going back 5 or 6 years ago, we built this neural network to try to estimate what the reserves in these shale basins are, because all of these shale basins, their impact has been massive. We've brought on more oil in the United States. It's like we brought on 2 Saudi Arabias, if you count oil and natural gas, in the last decade, that nobody expected. And I kind of joke that if you look at the Saudi textbooks from the 50s and 60s, they talk about oil. If you look at the US textbooks from the 2010s, I think if there's ever a mention of oil, it would have to do with, they destroyed capital and they were these stranded assets that no one cared about and these relics of the past. It's this massive energy resource we brought online that no one seems to realize. And no one seems to appreciate that it's now beginning to roll over. So we kind of validated it against 2 of the earliest shales, which have rolled over. They're down 60% from their peaks. That would be the Barnett and the Fayetteville, both gas shales. And they peaked and rolled over just when 50% of their reserves were produced, just like King Hubbert would have predicted. No one really knew whether the shales would adhere to those same rules as conventional fields. It turns out they do. So that begs the question, where are we with the other big fields, the Permian, the Marcellus for gas? And in every case, we are awfully close, if not past 50%. Wow. Depleted. That means that growth is going to be hard to come by. We made that prediction in 2019, 2020. Right. And we've seen no growth since then. The Marcellus hasn't grown for 2.5, 3.5 years at this point, maybe very, very, very modestly from when we made that prediction. We thought 2025 would be the year that everything rolled over. I think it's going to be in 2024. It almost doesn't matter because growth is just grinded to a halt now. Wow. Historically, when you lose the main source of non-OPEC oil supply growth, that's when the market tightens a lot. And that's when you could see prices re-rate. Again, historically, it's tenfold. Again, if you look, where did oil bottom this cycle? During COVID, it obviously went negative. Let's call $20 on like a monthly basis. Yeah, right. That's fair. So is it $200? I mean, the market can't sustain it when it spikes tenfold. Right. And every time you see demand destruction, but I wouldn't be surprised if that's where you're headed this time as well.
Yeah, and Brent right now is at 83.73.
That's right. And I think, we're using $100 in our long-term oil price
Okay.
models for our different companies.
Okay, good. Natural gas.
Natural gas is probably the most asymmetric trade that we see to the upside today, North American natural gas. So here in the United States, gas today, I better pull it up, it moves around so much. It is $2.05 per MCF of gas. In the rest of the world, it's $12. If you want the oil linked price, meaning if you want to convert, how much on an energy equivalent basis, you multiply
Right.
it by 6. So 2
Okay.
times 6 is 12 against an $85 oil price. So
Not even close.
not even close. The
Yeah.
US natural gas molecule is the cheapest molecule of energy on planet Earth by, you could argue, 70, 80%. Now, the question is, it has been for some time, and we actually haven't been invested in the gas market for quite a while.
So is the why here that we don't have the infrastructure to be able to deliver it?
Partially, yeah. So we have been busy building out infrastructure over the last 15 years. We went from being the world's largest importers of natural gas to the world's largest exporters of natural gas.
Right.
We built a huge amount of petrochemical. We built fertilizers. We switched out all of our coal to natural gas in terms of the power generation. So yes, we have not been able to build enough to meet this wall of gas that's been coming at us. And I remember vividly back in 2012, I suspect, maybe
Right.
2014, I sat with this oil and gas analyst, and we did on a napkin, like, how many rigs did you need based on how prolific the Marcellus shale was? How many rigs did you need to hold production flat in the US? And it was like 8, and we were turning 200. So we said, oh my goodness, we have a problem here. Now, the issue is that today we are set to build another massive, or not build, they're built, we just have to commission them and turn them on, massive slug of export capacity, LNG, that's going to go into the world market at the end of this year and into the end of next year.
Basically piping to ports and shipping.
Yeah, that's right. You have to cool the gas down. The pipes aren't really the bottleneck. What you have to do is in some cases they are, but what you have to do is you have to cool down the gas to whatever the temperature is in order to bring it into a liquid where it becomes denser, and then you can put it aboard ships. We're bringing on a lot of new LNG, 7Bs, it's a big number. We're bringing on a lot of new electricity, gas-fired electricity over the next 5 or 6 years, mainly to feed data centers. And the most important thing, though, is that we stop growing supply. Supply is actually going to be down this year. Again, no one has it in their numbers. I've spoken to all these people, whether they're the midstream guys or the LNG guys. I said, are you worried about sourcing the gas? They said, sourcing the gas? Are you crazy? We've had nothing but abundance for 15 years now. There's so much gas that you literally cannot mop it all up or soak it all up. That's changing just as we're bringing on all this new demand. So the question is, how long can you keep the price dislocated with the world price by 80%? The reason now is that you have a bottleneck. You can't reach out and get that world price. Right. But if you have more demand and more export capacity, then you have ability to fuel it. Even if it's like, one molecule, in theory, you should converge those prices together. There should be an awful lot of pressure to do that. Because in our, if you had a single molecule of excess export capacity, right, then a wily arbitrageur would be able to buy the gas here, run it through the facility, and export it.
What a great trade.
I think so. The gas stocks are cheap. They haven't really moved. They've held in better than the gas price, but we've had 2 back-to-back mild winters. It means we have more gas in the tanks than we ought to at this time of the year. That's the opportunity. Once the LNG comes online with no new gas production increases, which we don't see, and which is now, like I said, down over the last 7 months, you're gonna pin those prices together awfully quick.
Are there regulatory roadblocks at this point to?
Nope. There's a lot of talk about Biden having curtailed new LNG. That's for the sort of next slug of planned and proposed projects. Everything as it stands right now that is under construction, which is what's going to tighten the market. We're not talking about the next 3, 4, 5 years. We're talking about the next 12 months. None of that's at risk. Now, I do think that there could be a risk if gas prices converge with world prices and they go up 3, 4, 5-fold. And then all of a sudden, you're contending with, do you want to feed the export market or keep domestic prices low? I wouldn't be surprised if there was a moratorium on exports. We did it for crude oil for many years. For 30 or 40 years, you were not allowed to export crude from the United States after the 1970s period. that could happen. But I think you're going to have quite a bull market between now and then.
That's really great. That's really great. All right. We are roughly 50 minutes in. Anything else top of mind, important we didn't talk about that you'd like to express?
Well, I think that if there's a big picture here, it's that commodities are incredibly cyclical. They go through these periods where, the commodity markets are priced on the marginal unit of supply and demand. So they're volatile. They can move around a lot. In the 17 years that I've been doing this, I've seen oil go from 16 to 140 to 27 to 87 to minus 45 to 120 to 60 to 80, right? That was never on a market that was more than plus or minus 1% out of balance. Okay, so it's very dependent on the marginal units of supply and demand. And because of that, and because it takes time to bring on new projects, it's really cyclical. And what I mean by that is that, you have the period where the market's in slight surplus, slight deficit rather, prices explode to the upside. Companies can earn super normal profits, 30-40% free cash flow yields because they have their assets already and the price just moves. And so it all falls to the bottom line. That attracts eventually investor interest and investor capital. That money gets deployed into the ground with a delay. New capacity comes on with a delay, and it eventually overwhelms the market. Prices fall. Everything that was underwritten at the high price gets written off. Money gets impaired. People pull all of their assets out of the resources space. And that's why it's so boom and bust. And then eventually it tightens and it slips again into deficit and you're off to the races. That's where we try to focus. And it's critical to understand where you are in that cycle. And the best way that we've come with, we like to look at a couple things. We like to look at CapEx trends, or is CapEx increasing or decreasing, or deals increasing or decreasing? I don't mean M&A combinations, but like deals for new capital. And then we like to look at the weightings in the S&P 500 or the Dow, and how much is energy stocks or the Russell. And then we like to
what is that? What is that today in the S&P?
They're all-time lows.
Yeah.
Okay. The long-term energy weighting in the S&P is 14%. Bull markets tend to top out between 20 to 30%. You cannot crack 4%. Okay. The 100-year average is 14. Even if it gets back to 10, right? Bull markets will end at 20. That's where I suspect this one will.
And it's about,
starved for capital.
14% now.
Now, no, it's 3.8% now. The long-term average is 14.
Wow. Gotcha. And bull markets top out at 20. All right. I'll share a chart in my
please do, because I think it's so important. And the last one that we look at is, picture says 1,000 words. It's really simple. It's the price of commodities divided by the price of stocks. And we take that back 120 years to 1900, and you have never been cheaper. It has never failed as an indicator. If you buy at the bottom, even if the bottom takes 10 or 15 years to kind of flatline before it takes off again, you make amazing returns by buying.
Is that chart in any of your blogs on your website?
Yeah, we like to put it up a lot, and I'm happy to send it over to you.
Yeah, please do. And then what I'll do is for listeners or watchers that like to learn more, the website is GoRozen.com, GOROZEN.com. And they have a blog page on here, and you can learn a lot more about their business model.
We put all of our research in the public domain, and we encourage everyone to go, and it's very widely followed. About 60,000 people download it each letter, and we're happy to share it.
Adam, you didn't disappoint. I very much enjoyed the conversation, and if you're open to it, I'd like to check in the next quarter or so.
I think that sounds great. It was really nice talking with you as well, and look forward to talking again soon.
Okay, be well. Thanks so much, and thanks so much for watching or listening.